Hello everybody, in this video we're going to show you our tax module. Now the tax module is quite large and complicated, so we're breaking it into two different videos, one video for the normal tax and a second video for the deferred tax, okay, although they do merge together in this video. Okay, so let's go straight to it. Obviously tax is done under accounting. We're going to right click there, we're going to right click on taxes, right click on taxation, and then we're going to go to output. And now the first one we have is our tax computation, so right click on that. Now, instantaneously, you can see that was less than a second. It's done our entire tax comp, and it's pulled up around about 2,000 lines and produced this tax comp on demand. Okay. Now let's have a look at this screen. What we've got here, we've got the columns going across show how we actually calculate the tax and also how we calculate how we deal with this variance. We have a difference here, and they get dealt with off to the side here. The ones down the side here are how we do the calculations. So we'll actually go and have a look at that. So the first thing to look at here is this is our revenue, okay, which is made up of both income and expenditure. And this figure here, 2630, that is our profit before tax, and we can compare this to our income statement. We're going to have a look at that shortly. Okay, now the first thing we do in this column is take a simple tax calculation. We simply take the revenue number and multiplies it by 25%. We're using a 25% rate just to make matters simple, and we can do that calculation over here. Now what we do over on here on the taxable income, we take this one and modify it to get to our taxable income, okay, and that you use the calculations that we have over here, and then what we do is we then put through the tax charge also at 25% based on what the taxable income happens to be. And this differential column in the middle here shows us what we have to account for, and in this case it's 105,307, and we'll see how those ones come about now. Let's just go and have a look over here. So the breakdown of that is we have permanent is of 20,000. Let me just do this. If I paint that for you there, it's going to come out here to 105,307. So there we go, that's it. So it's made up of deferred tax, has a charge to the asset liability, and then we have the permanent differences coming through over here. Okay, so now we come back, and now down here we have different calculations. The first one is simply matching where they're the same. There's no adjustment. The amount is exactly the same, and that is the bulk of it. You can see the bulk of our numbers actually goes through there, 800,000 of that, and it's just these other ones. So then we have zero tax, where site tax like fines, for example, and it's not there's no deduction for that. So now you get that item would come through here. Then we get parameter. Okay, so you simply take our number, the book number, and multiply it by a parameter, and that'll give you the taxable income. So what we've done here, the classic example is doubtful debts. We take 25%, so we pull through 25% of our doubtful debts, and that becomes the charge that we can put through for taxable income. And then we have non-deductible. Now have a look over here. We've got a figure for 6,000. On each invoice we put through an amount where we say this amount is non-deductible, and usually the reason for that being non-deductible is that it's of a capital nature. So this will be things like consultancy fees or legal fees, travel. There are various items like this that the actual item is of a capital nature, and so it becomes non-deductible. There could be other reasons, not just capital nature, but then we simply record that for this invoice, either the whole or a portion of that invoice has a deduction, and we pull that through here. So if you have a look here, that was 93,000 the total amount, but we're only for tax purposes really taking off the 87, and that's we've done the adjustment there. And then finally the independent one that we want to look at here, this is where we have like fixed assets. So we calculate depreciation for fixed assets, but we calculate a separate wear and tear allowance for the tax calculation, and we can come up with a different number, and then that's going to give us a variance here. Okay, now all of these ones, what we do from a point of view of journal entry, put that one through to start with our simple tax, and then over here we put through these items, first the permanent difference, and then we put through the deferred tax. And deferred tax we double up. We put it through first to tax, and then we put it through to deferred tax as well. So we'll see how that one actually works now. Okay, so that is that. Okay, so let me come out of here. But that's still now, we still need a more comprehensive document. So let's just go and have a look here now. We're going to go and look at tax charge. Okay, so let's go back here, taxes, taxation, output, and tax charge. Okay, so this document here now that we're showing is going to pull everything together. It's going to show you income statement, balance sheet, it's going to show you tax, deferred tax, and it's going to show you asset and liability, so we can see every single aspect. Now the first three items here are straightforward. There's the 657 you saw, that's our simple tax based on that PBT of 2630. Then we have the permanent differences both current and prior year. This is pulling through the prior year items now. And that is joined in terms of the overall tax, the net tax that we want to show. It's joined by a deferred tax contribution rate change. And then if there's been an adjustment, basically if there was a bugger up last year, or if we've changed, got our numbers spot on now in terms of timing differences, book values, tax values, and then we look at this item, we might say that the opening balance had to change by these amounts because the algorithm doesn't work now if you don't do that. So here we have our figure now, and that comes out at 675, and that 675 will be what we have in the income statement. Okay. Now have a look at this block in green here. This is now our deferred tax calculations, and what we've done, this will sum to zero because what you have for normal tax, you have the opposite for deferred tax, so they contra each up. So we put that in a separate block here, and you can see these items, sum them up, they sum to zero. They're actually in balanced pairs, so each pair can be seen like that. So we're putting through the item, but from an income statement point of view, what you get charged on the normal tax, you get a credit for on the deferred tax. So this is very nice. It shows you that this is opposite and equal, but it actually, the columns now keep the actual individual accounts going. And here we can see there now on the tax charge here, we have to put through tax interest and tax penalties if you have them. Okay, so they will come through over here. Then we bring through the opening balance and the tax payment, and finally we end up with our closing balances. So these figures here, 739, 388, and 161, those are the balances that we're going to see now in our balance sheet. So I'm going to go straight back to those statements now and show you how that actually works out. You can come back to here, and you can do this at any point. Okay, come back to here. We go to our statements. We're going to go income statement. Okay, and over here, first of all, there's our profit before tax 2630, and there's our tax charge 675715. So those amounts are locked in. Okay, now we can go back to balance sheet. And now what we can do is go and have a look here. The first item, our deferred tax asset 388,682, and we can come back down here, okay, and we're looking at our tax payable 739. This is a credit because the bottom half of the balance sheet is liabilities, and then we can come down to a deferred tax liability 161,513. So you can see that from that document, all the numbers have come through. Now, what I want to show you, one last thing, is I want to show you the power of our journal system here. If I come back down to accounting, and I'm going to go back to taxes, I'm going to go back to taxation, I'm going to go back to taxation and output, and now I want to go to journals. Okay, so what I'm going to do, come down now to our tax journals, and what I have to do is just switch this now to account. Okay, and here's our tax account. Now what I want to do is I want to zoom in on our tax account, and then I'm going to switch this now to by category. And this is quite useful. So you can drill down and you can see this manipulation of the macro journals is a very, very powerful element. If I look on here, okay, and I'm going to go here by journal, okay, and here I've got my interest and penalties. These affect either the interest account in the income statement or expenses, okay, so that's dealt with up there. Now I'm going to come down to the tax charge, and you can see from this point of view I've got this, these three come through here, the simple tax and then the two permanent adjustments. And then finally, I've got my deferred tax coming through, and the total here is 155. It'll be offset in the deferred tax asset account, and the deferred tax liability account will total 155. Okay, and I've got that. So it's so easy to see this. And the whole point about this system is it's totally algorithmic. This comes straight, is driven by the codes that are in the populations. So all you do, most of the codes are standard. Sales will be 101 and exports are 102, and that will come through automatically. But occasionally you have to make a change. If you call in a tax advisor, he may be able to say, well, change this code, change this code, change this code, and we'll see what comes out of it in terms of how the tax computation works. But that's the actual tax computation. And so you've got that, and it all ties up. And of course, we've got perfect harmony between the underlying detail and the double entry system. So we've got that there. So that's our tax system, and we'll do another video on deferred tax. Thanks very much.